The same, of course, happens on the way down. We're going to have fixed mortgage rates in New Zealand falling probably next year, generally, more sustainable basis, before the Reserve Bank gets close to actually cutting the interest rates. Well, hello again, everybody. The Reserve Bank has just met the expectations of pretty much all of us economists and analysts in the market there by increasing their official cash rate again by 0.5%. So it now sits at 2.5%, whereas just under a year ago, it was sitting at about 0.25%. We've had a fairly sharp tightening of monetary policy in New Zealand over the past 3/4 of a year, and that's because our central bank, like other central banks overseas doing the same scrambling sort of thing, was caught out by inflationary pressures surging, which they should have reacted to early in 2021 by doing more than just bringing back the LVRs, as we could see from February last year, but also probably raising interest rates from pretty much a year and a half ago, and pulling back on printing money as well. But whatever, they're certainly getting the job done relatively quickly now, and yet in spite of this happening and the markets expecting this to happen, we've also seen the large lenders in New Zealand cut their 2-year fixed mortgage rates most recently. So you got to ask yourself, how can you get the Reserve Bank rapidly tightening monetary policy with more to come, maybe another % or so, and yet some of the interest rates are going down? It's because when a bank is borrowing money to lend to you or I, let's say, at a fixed interest rate for 2 years, the bank itself will borrow money in the wholesale markets at a fixed rate from somebody else for 2 years. And the cost to the bank of borrowing that money reflects what people in the markets who are doing the lending expect will happen with monetary policy, with short-term interest rates over the next 2 years. And of course, the expectation for a year has been that the Reserve Bank will get around to raising interest rates relatively quickly. And so you tend, when you get a monetary policy tightening cycle, for the fixed interest rates to rise well in advance of monetary policy itself actually tightening. The same, of course, happens on the way down. We're going to have fixed mortgage rates in New Zealand falling probably next year, generally, more sustainable basis, before the Reserve Bank gets close to actually cutting the interest rates. And that just reinforces, I guess, what I've been saying recently, that we are at or close to the peaks for the fixed mortgage rates for 2 years out towards 5 years. For the floating rates and 1-year fixed rates, obviously highly more tightly tied to what the Reserve Bank does with its official cash rate, some more upside left there. But for those other interest rates, it more reflects, like I say, the expectations in the market, and the expectations around the world have shifted to maybe the US economy is already in recession, maybe the world economy is going to have a recession, and if that's the case, interest rates might not need to go up as much as was expected previously overseas. We've seen international medium to long-term interest rates actually fall away 0.5% or so over the past few weeks. That is fed through into those medium-term borrowing costs in New Zealand, and the banks have simply passed that on in the point of the market where most of the competition is happening at the moment. The banks are choosing to fight for market share for customers with competitive 2-year fixed mortgage rates at the moment. Not so much floating rates. That's more an Australian thing. They compete with the floating rates. In New Zealand, the banks usually are trying to offer a discounted 1, 2, sometimes low 3-year rates, although that's fairly much a rarity. So there we are. We've still got generally a tightening monetary policy environment, but not necessarily the same thing when it comes to those fixed mortgage rates. And if I were a borrower at the moment, I would be looking personally at the 1 and the 2-year rates, but I definitely suggest you go and speak with your advisor about what's going to be optimal for yourself there. All the best.